Gold just had its worst month since 2008. It dropped 15% in March alone. And right now, Wall Street's biggest banks are quietly saying this is the best buying opportunity of the year. But before you do anything, watch this entire video because there are two very different outcomes here, and you need to know both. Hey, what's up everyone? Welcome back to the channel. Today, we're breaking down the gold market in the simplest way possible. No complicated charts. No confusing jargon, just what you actually need to know to make a smart decision. And I want to be clear up front. I'm not a financial advisor, and this is not financial advice. This is market education. Always do your own research before investing a single dollar. All right, let's get into it. First, let's make sure we're on the same page. When traders say a reset, they mean the price took a big dip after running up really fast. It's like a rubber band. You stretch it too far, it snaps back a little. That's exactly what happened with gold. Back in January, gold hit an all-time record of $5,594 per ounce. That's insane. Never been there before in history. Then, boom, it fell hard. Today, gold is trading around $4,654. That's about 17% below that all-time high. So is this a crash? Or a discount? That's the whole question. Here's why gold fell. And this part is important because it tells us whether the drop is real or temporary. Number one, gold got way overbought. Too many people piled in too fast. When that happens, a pullback is almost guaranteed. Think of it like a crowd rushing one direction. Eventually, people start taking profits and the price corrects. Number two, the Federal Reserve. The Fed signaled they're only cutting rates once this year. Not multiple times like people hope. When rates stay high, gold faces pressure because people can earn interest in savings accounts instead. Number three, the US dollar got stronger. Gold and the dollar usually move in opposite directions. Strong dollar means gold gets cheaper. But here's the key. None of those reasons mean gold is broken. They're temporary headwinds, not permanent problems. Now here's where it gets interesting. JPMorgan, Wells Fargo, Deutsche Bank, UBS, some of the biggest financial institutions on the planet, they are not panicking. In fact, they just raised their gold price targets. JPMorgan is calling for gold to hit $6,300 by the end of 2026. Wells Fargo says $6,100 to $6,300. UBS says $6,200. From today's price of $4,654, that's 30 to 35% upside if they're right. Why are they so bullish? Three big reasons. One, central banks around the world are buying gold like crazy. China's central bank has bought gold 15 months in a row. When governments are buying, that's a huge signal. Two, the Middle East conflict. Right now, there's an active US-Israel-Iran situation happening. Whenever the world gets scary, investors run to gold as a safe haven. It's been that way for thousands of years. Three, Fed rate cuts are still coming. Even if it's slower than expected, lower rates are good for gold. Less reason to hold cash, more reason to hold gold. Okay, so let's talk numbers. The stuff you actually need if you're watching this market. Support, that's the floor, the price where gold tends to bounce, is sitting at $4,550. If gold stays above that level, buyers are in control. First resistance, where gold might hit a wall on the way up, is around $4,800. Breaking through that would be a strong signal. Medium term, analysts are targeting $5,200 to $5,400 by Q3 this year. And the big bank year-end targets are clustered between $6,000 and $6,300. Put that cheat sheet on your screen right now. I've got it displayed right here. Now I promised you both sides. So here's what could go wrong. If the Fed doesn't cut rates and the dollar stays strong, gold could slide further. HSBC has flagged a downside scenario all the way back to $3,950. If the Middle East situation de-escalates quickly, safe haven demand drops and gold could pull back more. And if the economy surprises everyone and goes really strong, people rotate out of gold into stocks. So yes, there's real downside here. Don't put money in that you can't afford to lose or that you might need in the next 6 months. So here's the bottom line. Gold just gave you a discount. Whether that discount is worth buying depends on your personal financial situation, your timeline, and your risk tolerance. What I can tell you is this. The smartest money in the world is not running away from gold right now. They're watching these levels carefully and positioning for what could be a major move higher by year-end. If you're new to gold, don't try to time the perfect bottom. If you like the long-term story, consider dollar-cost averaging in, meaning buy a little bit at a time instead of all at once. And if you want me to do a full beginner's guide on how to actually buy gold, ETFs, physical gold, mining stocks, drop a comment below and I'll make that next. Like this video if it helped, subscribe if you're new, and I'll see you in the next one.